I have some unfair advantages in the market, but I also have some unfair disadvantages in the market. If you're interested in learning what they are, watch the rest of this video. Please like or dislike the video or leave a comment below. That will allow me to produce better videos and more of them in the future. So yeah, people often say to me, hey Peter, it's unfair. There are elements that you can do that I can't do. But in fact, when you look at the market in its proper form, there are very few things that I can do that other people can't do. And in fact, there are elements of it that are significantly disadvantageous for me. Well, let's start with things that work in my favor. And the interesting thing is most of these are stuff that you will gain from experience. So the first thing is that I have no or very little fear about the market. There's a great phrase that is often used, which is don't let the market, let the market be your slave and not your master. And the problem that you often have when you arrive in any market, any trading market, is that the market will bully you around. So I had somebody in the office recently and I was watching him trade and I said to him, I know what your problem is. And he said, okay, explain it to me. And I said, no, I'll show you. So as he was trying to trade, I just kept pushing him around and I was shaking him and nudging him and slapping him around the face and doing all of that. And he just sort of went, what are you doing? And I said, it's not what I'm doing, that's what the market's doing to you. That is exactly what's happening in the market. You're reacting to everything in front of you. You're doing something, the market's moving and you're reacting to it. And when in fact what you need to do is to be able to overcome that. You shouldn't react, you should have a plan, a strategy, and then you execute against it. And whatever the market does, you shouldn't, if the market completely disconfirms your trade, then obviously you should get out. But generally, if you've got a position in the market, you shouldn't let any short-term volatility shake you out of that. And that's the second advantage that I have, is that I can see through noise. And this is a learned thing, really. When you've watched hundreds of thousands of markets, and you've sat here every day for 15 years doing that, what you learn to do is you look at something and the market will move around and you just sort of say, well, go on then. It doesn't worry me. I'm happy with what I've done and I'll wait for it to mature. Or you're in a losing position, say in a certain type of trade. There are so many different ways of trading. I'm trying to encapsulate it all into one summary. But there may be certain trades where you're at a loss and, I would just sort of accept that there is a loss there and it may just turn around and come back in my favor. I'm not particularly fussed about it, but I'm just aiming beyond what I can see. I'm looking over in the distance and I'm sort of saying, well, this is what my general aim is and I'm going to stick to it. And I know that over time that will average out, but you only get that experience through working through so many different markets. But essentially what I'm trying to say there is if you see through the noise and you have a core strategy that's pretty solid, then there's no reason to be freaked out by what the market's doing in front of you or the fact that a trade is temporarily going against you. But the reason I can do that is because I have the knowledge. So over a number of years, I've worked meticulously at trying to understand everything that's going on. So it's not a case of me just having a wild punt or taking a position. I've got to explain what's going on and why, because if you can explain what's going on and why, then you can start to project forward. If you're just doing something on the basis that somebody's told you, that doesn't make much sense. So, when I teach people, that's what I try and do, is I try and give them the structure behind what's going on, because the advantage with that is it allows you to predict what's likely to happen. It's not going to say that it will happen, but it can give you a firm indication as to where things are going to go. So knowledge is really important. So I've modeled all of the markets, not just from a pricing perspective in terms of what the price should be before the start, but I've modeled how the price moves and why it moves that way and what influences it. You have a starting state here, you have an ending state here. What's changed between those two? What things can I see in front of me that could have possibly led from it going from here to there? What things have modified as we've gone through the entire market that's created that? So I've sat there and analysed that to death. And sometimes I waste many hours doing that and gain no additional knowledge. But when you have knowledge and you begin to understand what's going on, that gives you the confidence to be able to execute. The other thing that I've got, which is actually an advantage and a disadvantage, is money to burn almost. And I know that sounds funny and slightly frivolous to say that, but what I actually have, and I did this on day one when I first arrived, was I set up an account that I called my slush fund. And basically that account was there for me to lose. I basically sectioned it off and said, here's some money, that's for you to play with, and you just go off, and if you lose all that money, then that's fine. And the slush fund is for new ideas or strategies. So I can use the slush fund to basically go in, try something, and I'm going, well, that didn't work, that was a complete disaster. But every now and again, 1 in 10, 1 in 15, 1 in 20 times, you'll stumble across something that you probably haven't noticed before, or the market acted in an unusual way, and you sort of start homing in on that. And then you continually use the slush fund to refine what you're doing, and then eventually out of the slush fund comes a strategy, which then gets executed in the market. So yeah, you can do that too. That's the interesting thing, is I've got money that I can put through the market and do lots of interesting things with, and I'm very confident that I know what I'm doing and how much money I can risk. But the slush fund, and I suggest you have one as well, allows you to have an account where you sort of go, you know what, I'm expecting to lose all of that money, and that doesn't concern me. And you'll be amazed what difference that makes, because you'll try things that you've never tried before, and mysteriously every now and again you'll get a profit where you least expected it, and that will home you in on key strategies that you can explore or refine. So yeah, I have money and I'm not fussed about losing it, and I don't have to worry about earning X amount of pound a week or a month. I don't have to worry about that. But you can replicate that by having your own little slush fund. It could be £100, it could be 1,000 or 500, whatever you can afford, and you can use that fund and you section it off and you say, philosophically, that is money I'm going to lose, but as I'm losing that, I'm going to learn from it. So yeah, while I have plenty of money to put into the market and I'm not fussed about whether I lose some money or not, because I've got plenty of it there, I still have a slush fund. The slush fund is still there. I still use it for stuff, because that separates out experimentation behind true trading strategies. So if you want to replicate that, you can do that too. It's not really a major issue from there. But the funny thing about money is that is a big problem for me, because the market generally isn't big enough for me now. So when I started, I had virtually nothing, and therefore earning £10,000 or something out of the market over a period of time was significant for me. But the problem is, as your bank grows, if you're growing faster than the underlying market, then eventually you exceed it by a fair odd measure. And the simple fact is, a lot of markets haven't grown as fast as perhaps they should. So the problem is, if you look at racing, the average turnover on racing is about $500,000 a race. And that $500,000 is made up, if on Betfair you back with £10, then that £10 actually counts as double that when you look at market volume. So that $500,000 is really $250,000 in money that's been committed to the market and pushed through the market. So the problem is, with the track record that I've got, I could easily go out and raise millions. I don't need to, I don't want to, and I'm not going to. But what would I do with that money? If I raise more than $250,000 to put into the market, or I use $250,000 of my money into the market, that's more than the entire racing market. So I can't do that, and that's a big disadvantage for me. So the only way I can operate in the market is to scale stakes down to a level that the market will accept. And that's why it's very advantageous for new traders or people on smaller banks. You can trade the market much more effectively than I can. Your strike rate should be higher than mine if you trade it effectively. Because in fact, having smaller stakes in the market increases the opportunity of getting those orders filled, and that will increase your strike rate and your opportunity of getting a successful trade. Let me give you a clear example on this. If you put £10 into the market and you trade £10 in and you trade £10 out, nobody really notices. The market won't notice. You won't influence price activity or anything. Try doing that with £1,000 and you can't do it. If you put £1,000 into the market, your order will only be partially filled, and then when you're trying to trade out, you're going to struggle to trade out the full amount as well. So you've got two mismatched orders in the market, and probably most of it didn't fill anyway. Try doing that with £10,000 and you're completely stuffed. So in fact, you may think that having lots of money is a big advantage in this market, but in fact I would argue the other way around, that in fact having small amounts of money, small stakes, actually is much more effective, and you should be able to get the money in and out of the market much quicker than you can do with larger stakes. So yeah, it's not all a bed of roses. The challenge that I typically face in the market is getting enough money through it to make it worthwhile for me, and a lot of the time I just can't do that. And so that's a longer term issue for me, something for me to worry about and to figure out how to solve that problem. But essentially, you shouldn't let that be a major issue for yourself, because you can use smaller stakes and your strike rates and your ability to get in and out of the market quickly is much better than mine. So yeah, I have a few advantages. Most of those can be learned, but I have one really big disadvantage, and the only way that that will go away is if the market grows. And that's why I'm always keen to make sure that the market continues to grow. If you're interested in learning more about BetAngel, why not visit betangel.com today and download a free trial.